Hello guys, I hope you all are doing well, and in this today's video I want to discuss some of the questions that I'm getting and how we can solve that. So I've been getting a lot of messages and email about the market trend, and because we all know it's like almost at all-time highs. If you look at SPY or QQQ, right, that's even higher, and they don't have that much capital, and they're scared that if you put that much capital and it goes down, there is no kind of a saving point at that point, right? So how do you I want to answer the question on how you can actually leverage your money and still make that much return on your investment, and actually higher return on your investment than directly outright buying the stock, right? So that particular strategy I want to discuss in this video. And guys, if you have not subscribed yet, then please subscribe to my channel. I make a lot of videos around options, and I'm sure you're gonna benefit out of that. Okay, so I'm in my computer screen, and this is the strategy that I want to discuss, which is deep in the money call options, right? And this is a strategy a lot of people uses to kind of leverage their money, right? So I prepared a kind of a deck so that it's easier for me to explain, and also you will have some document to go back to if you have any doubts in this strategy or how you can execute this strategy, right? So let's start. So the key points, right? The one point that I already mentioned, right, that this strategy is kind of leverage your capital. So instead of outright buying a particular stock, you are instead kind of leveraging your money, but you are getting the similar exposure, right? So the key point that this strategy needs is a stock which is on which you are bullish, right? That is very critical, because that is your underlying basis. And the way the market trend is going right now, this would be a perfect strategy, because the market is, if you know, it's kind of in a very nice uptrend, and since November, right, all the dips that we have seen were kind of brought back immediately within like 1 or 2 days. And as long as that particular trend does not break, this would be a good strategy that would give you leverage and a very good return on your investment. Okay, so for this strategy, the another point is delta that you want to keep is about 90%, and I'm gonna take an example so that it's more clear. Okay, other points are that you're gonna check is that the break-even price, right? The break-even price for that option, once you buy that into that option, the break-even price has to be closer to the current stock price. Again, I'm gonna explain all this with a good example, so that would be more clear, right? And you should target for at least 50% discount versus buying the stock outright. So let's say, for example, you had to spend $5,000 to buy 100 shares of a stock. You should not spend more than 500 to get into this position, right? That's kind of a target. Ideally you should be aiming for something lower than that, right? Okay, so some of the things that before we get into the example, right, there could be three scenarios in which you would find yourself at the time of expiry or even before expiry, right? So one is a close, right? So as you know, option, you can always it's a kind of a your right, you can always sell that option, whether it's a profit, or if you see that particular underlying, you don't have that much confidence in that particular underlying, you can always get it out of that options, right? In case of a stock, that is not possible. Once you buy into the stock, that loss would be higher in compared to the options, right? To get out of the options would be much, in both cases you would have some loss, but in this case you would be much better off just maybe 5-10%, and you can get it out of the trade immediately. Okay, the other thing that you can do at expiry or even before expiry, you can always exercise your option to buy into the stock, right? So if you are still bullish in that particular stock, and since you have bought at like a 90% delta, that's almost closer to the spot price of the that particular underlying. So you can always exercise. You will have to pay that balance, and then you can always sell covered call against that particular stock, right? So that's another strategy that I have explained in another videos. If you are not familiar of that, you can definitely go and watch that. That's also a wonderful strategy in kind of a bullish to neutral market. Okay, so the rollout, right? So other thing that you can do is you can always once the expiry reached, you can always roll it out to another month or maybe 2 months, right? So until you have a good confidence on that particular underlying and you think that it would recover in the future, you can always roll it out, and there is no limit, right? You can roll it out further and further into the future until you kind of go in a good spot to either sell it or just close it out, or you can just exercise the option, right? It's all up to you based on how the stock is doing at that particular time. Okay, so now let's take a good example, right? So I have taken an example of Walmart because if you look at the chart, right? This is Robinhood, right? So if you look at the chart for Walmart, right? This is the kind of chart that you would want to see in a stock that you are going to do this particular strategy. And also the other thing is the implied volatility, right? You want a stock which is not highly volatile, and Walmart is a pretty stable stock. So this is a stock that a good fit for this particular strategy, right? And the graph is almost a linear kind of a graph that you want to see with in terms of growth. So this is what I'm going to take as an example for our case, right? So let's go back to our deck. So if you look at here, right, I've taken example of a stock versus options, right? So in case of a stock, if you have to buy 100 shares of a stock, which is currently Walmart is at 61, right? So you will have to pay $6,100, right, to get into that particular stock. And your max loss and max gain is, max loss is the stock could go to zero theoretically, and the max gain is it could go to infinity, right? So that's the kind of a profit and loss potential if you outright own 100 shares, right? But the capital that you have to invest is $6,100, right? So this is the point of this video, right? If you do not have that much capital, or you do not want to put that much capital at risk, what you can do is you buy a long-term call, right? So you buy, let's say, a September, right, which is almost 6 months, 6 months plus, right? So you buy a September call, and I think I already checked this one when I believe let's go back to the options chain, right? So if you look at September call here, right? So September call, if we look at 55, right? 55 is almost, if you look at the delta here, the delta is 91. So this is what we want, right? Delta is 91, and look at the implied volatility, right? That's 14%. That's pretty low and very nice for when you go into buy call option, because when you buy a call, the theta that you see here, right, the theta goes against you. So you do not want to have a stock or this strategy for a stock where the implied volatility is really high, because what will happen is the theta would increase in that case, and that will eat up on your profit. So every day that you hold on to that particular option, this is gonna eat away your profit, right? So we do not want that. So this is a perfect one because the IV is pretty low and the stock is pretty stable, right? And the delta is 90, which is giving us exposure as very close to owning that stock as well, right? So delta, if you do like just a quick thing, if like delta just shows like how much of a $1 move in a stock price would increase that particular amount of the stock. So let's say the stock is currently at $100, right? And if it goes to $101, and this is the amount that your profit will go. So in a stock, if you own, your profit will go for $100, but if you own an option with a 90 delta, your profit is gonna be $91, right? So that's pretty basic of the delta. Okay, so that's the setup. And if you look at right how much we are paying only $825 here, right? So I think when I took this slide, it was 840, right? It is further reduced. So just assume, like, let's say it's $840 that you pay, right? So look at the difference. You are paying $6,100 before. Now you are only paying $840, right? And the profit and loss graph looks pretty similar to that one. You're getting the full exposure of the upside and your downside is capped, right? So that's the advantage that you're getting here. Okay, now let's move on to how the profit would look like if, let's say, Walmart goes to $71, right, at the expiry. So that's what I want to compare between stock and option, and how your return on investment differs based on these cases, right? So let's say Walmart goes up to $71, right? So your total profit, if you own 100 shares of stock, that's pretty straightforward, right? Your total value of the stock would be now 7,100. You bought it for, your cost basis was 61, so your profit is $1,000, right? If you look at the return on investment here, right, your return on investment is only 16% in this case. Now look at the option for the same case. If Walmart goes up to 71, your contract value, so this contract value, how I have got it, I kind of make use of this website, which is Optionstrat, right? So in this if you look at the long call option, right, you can actually look at here. So this is September, right? September we did this Walmart, and we were doing the 55, right? So we did 55 call, and this shows a nice graph which you can see, and you can also look at the profit and loss. You can look at from the number perspective or percentage perspective or the contract value, right? So I just want to see what would be the contract value if Walmart is at 71, right? So let's increase the range a little bit, so we see here. So okay, so now we have the 71, right? So let's look at the expiry, right? So at the expiry, if the Walmart is at 71, you see here, right, 16, and as you know, we have to multiply that by 100, because in options everything is for basis of 100 stock. So 16 here, that means your contract value goes up to 1600, right? And remember, you bought it this one for $840, right? You bought it for 840, and the same call option goes to 1600, right? So your total profit here is 760, right? But look at the ROI. You only spent $840 to make $760, right? That's almost doubling your money in this case, versus if you had owned that stock, you are only making 16% return on investment, right? So look at the difference here. So this is the power of options, right? If you use it perfectly with the right criteria and your exit criteria set with a proper setup, this is the power of options, right? And as I explained here, right, you have multiple options. At the end of the expiry, you can always exercise the option, right? Exercise is, you can always buy back that contract, and that will give you the basically you own the right to buy the shares at the strike price, right? So you are basically going to buy your shares of Walmart at 55, even though the current Walmart price could be maybe 70, $80, right? Whatever be the price, you have bought a contract to buy those shares at 55, right? So that's your capital gain as well. So that's the power of options. So this is what I wanted to discuss, guys. This is a wonderful strategy if you want to leverage your money and you do not want to put that much capital at risk, but still you want to get the same exposure, right? So to do that, this is a perfect strategy for that. And you can always, as I said, you can make use of Optionstrat, and you can close it out early as well, right? So let's say there is a big news in Walmart and it goes up to, let's say, 67 itself. It goes to like it's April 19th, and it goes up to 67, right? So your contract value is 1300 13.25, which is $1,325, right? So you're already up in this, right? You're already up percentage terms, right? If you look at here, you're already up 60%. You can very well sell the option contract that you have, and you make that profit, right? So that's a nice way, and you can see all that graph here. So this is what I wanted to discuss, guys. I hope you liked this video, and if you did, do give a thumbs up and subscribe to the channel if you have not. I'm gonna make thinking of making a whiteboard series soon, and if you have any questions around options, I'm gonna answer in that. I'm gonna start from a beginner level. I'll go to the intermediate and advanced topics as well. So do subscribe, guys. I'm sure you're gonna benefit a lot. I'll talk to you in my next video. Till then, happy investing. Bye bye.